Hi everybody, this is Ted Bauman here from the Bauman Letter. I'm here with two of my colleagues, Shoop and Michael Carr, and we decided today we wanted to talk about something that has really been on everybody's minds, and that is the subject of bear markets, corrections, downturns, whatever you want to call them. And obviously people right now are making a lot of money in the stock market, but the question is, how should I be thinking about a correction? What should I be doing to prepare for it? So I thought we'd all get together and just kind of have a little bit of a jam session, how we think about these things amongst ourselves. So let me ask you first, both of you, how do you define a bear market? I mean, what's your sort of a criterion for saying this is a bear market?
Sure. I consider a bear market of a drop of 20% or more. A correction is usually just under 20%, but over 10%. But really, I mean, a bear market should last a little bit longer than that. So if we drop just 20% and then it rebounds pretty quick, that could technically be a correction. So I'd like to see a bear market last for an extended period of time.
So it's a question of the depth of 20% plus some time.
Yeah.
Mike, how do you look at it?
I define a bear market as an 11% drop over 55 trading days or more, so maybe a little bit more technical.
That's fine.
But the idea is it's not necessarily a 20% drop. A bear market is a painful life event, and an 11% drop over 2 or more months, that's painful.
So it's a psychological thing.
Correct.
Really. Well, it's interesting that you say that because I was thinking earlier today that in many cases the stocks that we see dropping haven't lost any real underlying value, but psychologically people want to sell them anyway, and so part of it is just about psychology, isn't it?
It is. Now there's interesting studies done that show a loss hurts 2.5 times more than the joy that you get from a win.
Right.
So I describe it as a teenage girl. And if you look at the breakup, if you have a teenage daughter, her breakup crushed her. Right. 2.5 times more than the joy of that first
of
date.
getting in the relationship in the first place right now. Now let's talk about the likelihood of a bear market. Now, I'm not going to ask you guys to commit to anything. None of us would be so bold as to do that. But I've always said to people, I mentioned in my speech this morning, I said, somebody said, Paul Mampilli says we're going to get to Dow 50,000. You say we're going to have a bear market. They can't both be true. And I said, of course it can be true. It will be true. It must be true. What do you think? What are we headed for and over what sort of a time frame?
So I mean, I agree with you. Both will be true over a certain time frame, right? Where there's going to be another bear market. It's just a matter of time. Yeah. No one really knows when that's going to happen. We all have our indicators and everything that we watch to try to determine when that will happen, but it's just our best guess. Right. So from that perspective, we can just prepare for the worst, but in the end, as long as we're in a bull market, you have to keep benefiting from the bull market.
And when should one prepare?
When?
Yeah.
When it's not too late. You do your best about following the indicators and just being ready to adapt. The best thing to me would be to have a sound strategy that kind of benefits from both, at least early on, and then once you're definitely in a bear market, then you can start implementing strategies that are better in a bear market. But in that medium term where you're trying to figure out if it's going to stay in a bear market or turn into a bull market still, there's a lot of whipsawing that happens there, so it's best to have a sound strategy to keep making money during that period. Right.
Michael, what's your prognosis on market correction?
I think we're going to have a bear market, of course, and the time to prepare for that is today. Too many buy and hold investors thought they were in it for the long haul, and in 2008, 2009, as markets fell 55, 60%, they panicked and they sold. They were not prepared for what happened. Right. So buy and hold is actually the riskiest strategy possible. Right. Maximum drawdown, 90% of a portfolio historically. People weren't prepared for that. They got killed, and then they didn't know when to get back in. So the time to have a plan for the bear is today, while the bull is still alive.
Right. Well, what I always tell people when they ask me when is the bear market coming is that's the wrong question. The question should be, how do I allocate my assets so that when it happens, I'm in the best position? And I think that's what you're saying, is you need to have a strategy today that puts you in the best position to bounce back. So what kind of strategies do you guys recommend? Chad?
I mean, right now, just a strategy that's going to benefit from both sides. Like in my services, we can take money on stocks that are going down and benefit, and also benefit from stocks that are going up.
You're talking about options trade.
Yeah, well, with options and also with inverse ETFs.
Right.
So we can use that to benefit from sectors that are starting to decline. Even if it's before a bear market, we already have strategies in place that we're trying to make money on both sides of the trade.
Right. Michael, what do you think?
And I agree to just have a plan in place to make money on both sides. So a simple idea for my service is the 200-day moving average. As soon as we fall below it, buy put options. And it can be that simple. Have a plan, stick to the plan.
Have a plan. Now, one of the things that I've written about recently in the Bauman letter is managed futures, and you were saying something about that earlier. What's your take on that strategy?
So managed futures are one of the few strategies that delivered a gain in 2008 and 2009 and continued to deliver gains in the bull market.
Right.
They're one of the few strategies that actually just moves whatever's going up, they're long. Right. Whatever's going down, they're short.
That's right.
So it's the ideal strategy, kind of an all-weather kind of strategy.
Right. And what's interesting about managed futures is that it's not something that you can start acting on the day that the market turns. You actually have to have bought into them beforehand and be willing to accept that they're not going to be as they're going to perform like the market while you hold them. But boy, when that turn comes, all of a sudden they boost. The statistic that impressed me was that over the last 5 major market corrections since the early 1990s, the average upside for managed futures has been 15.5% for each one of them. And that includes 2008, 2009. So the question, as always, is not whether to do it, but how much of your portfolio to do it with. Because if, like you said, if you're all in, that's a big mistake no matter whether the market is going up or going down. So it really does come down to allocation. So let me ask you this. How should one be optimally allocated if you're, let's say, a lot of the people here are retired or close to retirement. Is there a rule of thumb that you guys use? Between stocks, bonds, non-correlated?
Yeah, I think the managed futures are, and I think it's wonderful that they're now available to individuals. As you know, institutions have used them for years.
For years, yes.
And a lot of pension funds, CalPERS with billions of dollars, puts 10 to 20% minimum into managed futures, and alternatives are now up to about 40% of institutional investor money. So the smartest minds in the world are telling us, do not do a 60-40 portfolio.
Right.
You put at least 10% minimum, probably more than that, into managed futures since they are all-weather type. Good and bull, good and bear markets.
That's right. And they're a complement to the options and inverse ETFs and that sort of thing. The idea being that you can preserve capital and actually have money to invest when the market comes back in, whereas an all-in strategy means you've got to climb the whole mountain by yourself all over again. Anyway, that's us talking about bear markets. Unfortunately, we're not going to pick a date for the next correction, but we are all in agreement that one will come simply because they always do. We've offered some ideas here about what you think you can do to prepare for them, but the main lesson is do it now, not later. Anyway, thanks very much.